Welcome to ATM Trading Club. In the following few minutes, you're going to watch a video that was produced by ATM Trading Club. The narrator of the video is called Vega. That's his Discord name. He is also one of our members that through us has been learning, experiencing, and advancing in the success of his trading skills and his success of learning how to trade profitably. In a few minutes, you're going to watch how he explains the basics of options. We are also in the process of producing content, not only for the beginner, but for the intermediate and expert traders. We are also putting together special strategies so the trader can have access to different type of strategies in order to make money trading options. Here at ATM Trading Club, we proceed a vision of success through education. We are all the way in with you and mentoring your success to make sure that you are successful in every way possible trading options in the stock market. With no further delay, I hope you enjoy the video. Please hit that subscribe button, hit that like button, and any feedback will be gladly appreciated in order to improve our service. Again, thank you very much from all the members of ATM Trading Club. Have an awesome day.
This video is about stock option basics. Stock options are contracts with rights and obligations that are created between buyers and sellers. When buying a stock option, you are considered to be long that option. When selling a particular option, you're considered to be short on that option. The two main types of options are calls and puts. One of the key aspects about stock options is the fact that they do expire. The amount of time to expiration is a key component in their pricing. Expiration can work in your favor. Expiration can also go against you as you're trading. This video is not intended to get into that level of detail. However, we will cover the basics about stock options, how they work, and why they're so popular. What is a stock option? A contract that controls 100 shares of stock. Contracts are traded between buyers and sellers on stock market exchanges. How are stock options traded? Applying for and funding a brokerage account provides access to a trading platform. The platform displays stock charts that show price movement, and it provides a list of option prices in a spreadsheet called an options chain. Each contract controls 100 shares, so the contract prices must be multiplied by 100. The chain can display the number of open contracts and how many have traded during the current market session. Several other items may also be displayed. Let's take a quick look at an options chain. This is an options chain for Apple. We can see that we have a closing price. The market is closed today, closing price of $149.32. We see Apple over here in a watch list. We see a value of 149. That value means $149. This is an option that if you were to purchase a call, you would be looking for Apple to increase in price, and as it did, the value of this option would go up. To purchase this option, we see two prices, a bid price and an ask price. Let's take a look at a highlighted sheet so we can keep track of these items. On this sheet, we see that we've selected a ticker symbol, Apple, an expiration date, October 29th, 2021. Looking at the 149 call option, calls are on the left side of the spreadsheet, puts are on the right side of the spreadsheet. At the time that this screenshot was taken, the 149 call had what is known as a bid price of 214. That's the price someone else would be willing to pay to buy this option contract from you if you already owned it. The ask price is $2.16. That is the price you would be asked to pay to buy the option. So immediately upon purchase, if you paid $2.16 for the option, you would be down 2 cents if you immediately wanted to turn around and sell it. The difference between the bid and the ask is called the spread. Currently on this option contract, the spread is 2 cents. When you go to place an order with this particular platform, it will show you the 214 bid price here, the 216 ask price here, and a highlighted price of $2.15, otherwise known as the mid, meaning you would have a chance to try and split the difference and say, since you would be offering $2.14 to buy this back from me, and you're asking me to pay $2.16 to buy it, I'd like to see if we could split the difference and have me enter into this contract at $2.15. So what's involved in purchasing an option is for a trader to select a ticker symbol, being Apple, an expiration date, in this case October 29, 2021, a strike price of $149, and an option price which currently is $2.15. The debit for this contract would be $2.15 plus $12 in regulatory fees and whatever commissions the brokerage that the trader is working through may charge to purchase the option contract. In this case, this platform has a $1 commission for each contract purchase, so the total is $2.16 and 12 cents per contract. If you're to do 2 contracts, the contract price would go to $430, the fees would go to 12 cents, and the commissions would go to $2. In either case, the total maximum loss on a trade like this is limited to the total cash outlay, meaning no matter what happens with Apple, however far it may drop, the maximum loss on this trade per contract would be $216.12. To look at how an option behaves, let's look at the performance curve. This is a performance curve based on looking at the 149 call on Apple. With Apple priced just below $150, if Apple were to increase in price to what's shown here as $152.50, $155, $157.50, $160, as the price of Apple increases along this axis, the value of the option purchased would also increase. This could go up to, it's showing a little over $2,000 here. There's really no limit to how high this option price could go because there's no limit to how high the price of the Apple stock could go. The considerations that would run counter to that are the time duration for the option. If the option is scheduled to expire, which this one is on the 29th, which is only 3 days away, it's not likely that Apple could make an excursion and shoot to the moon and cause this option to be valued in the thousands of dollars, but you do see this ramp indicating how that option price would increase. Call options profit from rising stock prices. Apple could rise to any imaginable price, so the profit potential is unlimited. The contracts and obligations that are a part of using options involve rights received when an option is purchased and obligations incurred when an option is sold. During the application process, most brokerages will require applicants to check a box indicating that they have read this document. Trading options involves risk. The document is called Characteristics and Risks of Standardized Options. This document has been modified several times. This link will lead you to one of the more recent versions of this document, although cannot say for sure that it's the exactly most recent issue It's important to understand the risks involved in trading options. For instance, markets can have wild price swings. Your brokerage or your internet service could fail. Your computer could lock up. A news event could trigger a market crash. And traders can make order mistakes. I've made ordering mistakes, and I can tell you it's very easy to do. When we get back to the options chain, I'll show a couple of ways how that can happen. When a trader buys a call, they have a right, but not an obligation, to buy shares of stock at the contract price. The reason for buying the call option would be to lock in the price you would pay for a stock, hopefully at a lower price, and then as the stock rises, you would have a contract saying that you are able to purchase the stock, in this case at $149, even if Apple were to go to $150, $155, or $160 or higher before the contract expires. When a trader buys a put, they have a right, but not an obligation, to sell shares of stock at the contract strike price. Puts originally were considered an insurance policy. If you purchased Apple, let's say, at a higher price, $150, and you bought the $149 put, if Apple's price were to go below $149, you have purchased an insurance policy using this put that says even if Apple were to go down to $140 or $135 or lower, you have the right to sell those shares of stock for $149 because that is the value of the put option purchased. In reverse, when buying options, the losses for the trade are limited to the amount paid for the options contracts. This is where we reverse how options work. When a trader sells a call, instead of having a right, they now have taken on an obligation to sell shares of a stock at the contract price unless they have managed the trade in a way that reduces the risk. To do that involves a little bit more sophisticated trading, which we are not going into in this video. When a trader sells a put, they have taken on an obligation to buy shares of a stock at the contract strike price unless they manage the trade in a way that reduces the risk. This also is a little bit more involved than what this video is intended to cover. But the point being that when a trader is selling options, the losses can be unlimited. The reason for that would be if a trader were to sell this $149 call, they're hoping that Apple price will stay at or below $149 so that the option could expire worthless and they would keep, let's say, the $2.15 premium that they sold the option for. However, if Apple stock rises, the seller of a call would have an obligation to sell those shares at the $149 price, even though they might be selling at $160. Where the losses can become unlimited is you would have to purchase those stocks at $160 because that's the current market price, and then turn around and sell them to whoever bought the call from you at $149. That is where losses can occur, and they can be very high. Why do people trade options? The reason for that is leverage. Going back to using Apple as an example, if a trader thinks that Apple could move from $149 per share to $150 per share, they could make $100 in profit by buying 100 shares of Apple at $149 per share for $14,900. and then selling those shares at $150 per share for $15,000, and this would create a $100 profit. Looking at options pricing, I researched a call on Apple, the 149 call, on October 26, 2021. The 149 call option price for the day had a low price of $2.26 and a high price of $3.35. The difference between those prices is $1.09. Each contract controls 100 shares, so the maximum potential gain for the day was $109. A cash outlay or a debit of $226 could have returned $335. That's approximately the same gain as buying $14,900 of Apple stock and using $14,674 less in cash. This leverage is what has made options so popular. Let's look at that by the numbers. If we see Apple at a price of $149 and we purchase 100 shares of Apple, we would have a cash outlay of $14,900. If Apple were to go to zero, that would be our maximum loss. Our maximum loss would be the amount of shares we purchased times the price we paid, in this case $14,900. The intention for the purchase of those 100 shares was hoping that Apple could rise at least $1 to $150 per share. We would have 100 shares that we could sell at $15,000, and our profit would be $100 on 100 shares. Using options, we now see in the numbers why we have so much extra leverage. We could purchase an option at $2.26 multiplied by 100, since each option contract controls 100 shares of stock, and we would have a cash outlay of $226. Apple could conceivably move higher in price in such a way that the value of that option could go to $3.35, leaving us with a profit of $109 per contract, and yet our maximum loss would be $226. So we have a chance to make the same type of profit on Apple, approximately $100, using much less capital at risk. We see that the difference between the $14,900 stock purchase and the $226 option purchase is $14,674. That is the power of options. If Apple were to drop to $0 on 100 shares, the loss would be $14,900. Options would cap that loss at $226. Let's wrap up what we've talked about so far. Options are contracts with rights and obligations depending on whether they were bought, long, or sold short. Two types of options are calls and puts. Every contract has a specific ticker, expiration date, strike price, and option price. These are all chosen by the trader. Trading options involves multiple risks, including wild price swings, brokerage or internet services failing, computer problems, news events that trigger a market crash, or making a mistake when placing a trading order. Becoming good at options trading takes practice and discipline. Options are popular because they provide leverage for smaller amounts of money to produce large gains. Now let's take a look at how you need to be very careful in trading options, especially when you're new, but even when you're experienced. One mistake that could be made trading Apple, let's remove the highlighted leg here. Let's say that we wanted to get into a trade on Apple and we knew that we wanted to use the 149 call, and we came over and accidentally clicked on the bid price. That is going to set up a sell order. That sell order is shown down here as a -1 for the -1 contract. What we're seeing is the maximum profit would be $232, and the maximum loss could be infinite. Now, how could that happen? Well, because we are selling a call which is intended to make money as the price of Apple drops. But in this case, if Apple rises to $155, $157.50, $160, this value is going negative because as this price increases, it's the cost it would be required to buy back the option. So that simple trading error could set up a trade that has a potentially infinite maximum loss. Another trading mistake that could happen, let's delete this leg, would be that we know we need the bid price. We know that we need the bid price and not the, or we know that we need the ask price, not the bid price. The mistake we made here was clicking on the bid when we needed the ask. A similar but different mistake could be knowing that we need the ask in order to buy and not the bid in order to sell, but we've mistakenly selected the put. So we click here and we are +1 contract. We could have a maximum profit of $14,694 if Apple were to go down, and we would have a maximum loss of $206 if Apple were to go up. Well, if Apple was in a strong uptrend, then what would happen is we would only make money on an option if Apple's price went down, and we would lose all of the money we spent purchasing that options contract if Apple were to go up. Other mistakes that could be made are in pricing out options as far as a quantity price. Let's go back to our 149 call. Let's say that we have clicked on the correct side. We're going to delete this leg. But for some reason, we forgot that we wanted to know what our profit might be or what our loss might be if we did, say, 10 contracts instead of 1 contract, and we accidentally bumped this order up to 10 and decided in our mind, maybe we don't want to do 10, we just want to do the 1, but then you go ahead and submit the order and it turns out that you purchase 10 contracts. That is another type of mistake that can be made. And also in reversing an order, a mistake that can be made is that instead of clicking to close the order, we click to duplicate an order and you end up with 20 contracts instead of the original 10. So those are some things that can happen that can make for serious options trading mistakes, and that is why we want people to know trading options does involve risk, and some of those risks can be mistakes made while placing an order. Other things beyond our control could be brokerage or internet services going out. But the reason that options are popular is because they provide such huge leverage for such good gains instead of tying up such large amounts of capital. I hope this has been a good introduction for you to get at least some basic understanding of options, what they are, and how they work using calls and puts.